Welcome to another video in our crop insurance series. Today we're going to be talking about the Rainfall Index. So what is Rainfall Index? Well, this is a policy administered by the USDA Risk Management Agency, or RMA. And this is for growers of annual forage, apiculture, and pasture rangeland and forage. So with the Rainfall Index, lack of rain is the only thing that is insured against. So this does not measure your direct production or your direct loss. So what does Rainfall Index cover? Like I mentioned, it's for annual forage, apiculture, and then pasture, rangeland, and forage, or PRF. So basically it's hay and honey is what you're insuring against loss of rain. So with the Rainfall Index policy, there are several different components, and all of these are selected by the grower except for the grid. But intervals, productivity factor, and coverage level are all selected by the grower. And we'll go through each one of these components. So first up is the grid. And this is based on an average rainfall for your specific area. And this is something you don't determine. It's determined by the RMA using rainfall data. But the grid is about a 0.25 degree grid in longitude and latitude on the map. So this equals about 17 miles by 17 miles. So if you have land or colonies, bee colonies in multiple grids, you would need a separate policy for both those grids or however many grids you had. However, you don't have to insure all of your land or all of your bee colonies. So you could choose to insure just one grid if you had multiples, or you could choose to insure just specific fields or just select colonies within your grid. Next up is the interval. So these intervals you choose from are 2-month periods. So the grower gets to choose which 2-month period they want, and it's things like February and March, April and May, or May and June. So the grower selects which interval they think there's a chance of low rain, low average rain, or less rain than the average. And a grower must select at least 2 intervals that are not consecutive in order to have a policy. So they'll want you to choose, which 2 intervals you think will have less rain. And then the next component is the productivity factor. So the productivity factor is basically how the producer thinks their crop compares to the county base value. So they can choose between 60% of the county base value all the way up to 150% of the county base value. So basically they're asking, are the producers' lands or colonies producing less than, more than, or equal to the average production for their county? So the grower needs to say, I think my fields are capable of producing more than the county average, or my lands typically produce less than what is recorded as the county average. And this will help with the amount of payment determined if there is considered a loss. And the last thing growers choose is the coverage level. So they would choose between 70 and 90% coverage, and this is in intervals of 5%. And so basically it's how much rain rainfall for your interval do you want to ensure that you have. So here's an example of when you would receive a payment, and you would only receive payment if the rainfall in your grid drops below the coverage level you've chosen. So for example's sake, and for ease of example, we'll say the grid our fields are in gets 10 inches in the 2-month period that was chosen. So, that is a ridiculous amount. But for example's sake, to make this easier to understand, we'll say 10 inches in the 2-month interval. So let's say we chose 90% coverage level. And during those 2 months, the actual rainfall was 8 inches. So compared to the 10 inches on average, there was a decrease of 2 inches. And so that dropped below 90% of the average. So we would receive a payment. However, if we had chosen the 70%, so we're choosing to say we're okay if the rain is 80% of average or 90%, but if it drops below 70%, we want a payment. However, if the rainfall was actually 8 inches instead of the 10 on average, we would not receive payment. And to wrap up, I just want to remind everyone of our webinar series. Our next one will be on April 12th, and that will be a grower panel with growers that have experience in crop insurance. In May, we'll do a step-by-step example with an imaginary farm through some online tools and looking at which policies or programs might work for that farm. Then I do want to acknowledge our funding that comes from the Southern Extension Risk Management Education Center and the USDA National Institute of Food and Agriculture. Thanks for watching.